Welcome back to the Wall Street Podcast. Today, we're taking a deep dive into JPMorgan's latest research report on Netflix. This one just came out August 17th, 2025.
That's right. It's titled NFLX Trending, and it really zeroes in on, well, three key things. The outlook for the rest of 2025, market share dynamics, which are always crucial, and advertising, specifically how fast that's growing.
And they're sticking with the neutral rating, $1,300 price target. We should definitely unpack that later.
Exactly. It's a key part of the analysis.
Okay, so let's start with the financials. JPMorgan sees upside to Netflix's guidance for 2025. Guidance they already raised. What's behind that positive view?
Well, there are a few factors lining up. Favorable foreign exchange, with weaker dollar, that helps. Plus, just solid subscriber growth, and that advertising momentum we mentioned is really picking up steam.
So what are the actual numbers they're projecting? Revenue? Cash flow?
They're calling for 2025 revenue of around $45.1 billion. That's hitting the high end of management's own guidance. It represents a pretty strong 16% year-over-year growth.
16%, okay. And margins, free cash flow.
Yeah, operating margin forecasted at 29.8% for the full year. And free cash flow expected near $8.5 billion. Again, right at the top end of guidance. So financially, things look quite healthy.
Right, the numbers seem strong. But, in streaming, market share and engagement are just as critical. How's Netflix doing there, especially with competitors like YouTube really pushing?
That's a fair point. The report notes Netflix's U.S. TV timeshare dipped slightly in June, down to 8.3%. And meanwhile, YouTube actually gained share, up to 12.8%.
Not ideal. What about overall viewing hours?
Total viewing hours grew, but only modestly, about 1% year-over-year in the first half of 2025.
Okay, so maybe some headwinds there. How are they planning to counter that?
The report really emphasizes the second-half strategy. They expect a significant ramp-up in engagement. It's banking heavily on a powerhouse content slate. Think Squid Game, Season 3, Stranger Things, Season 5.
It's big hitters.
Exactly. And, importantly, live sports are entering the mix. They mentioned the Canelo versus Crawford boxing match, plus 2 NFL games on Christmas Day.
Ah, live sports. That could definitely move the needle.
That seems to be the plan. Create those must-watch moments.
Okay, shifting gears to advertising. You said the momentum is building. Sounds like the ad tier is doing well.
Exceeding expectations, according to the report. It's actually on track to double advertising revenue this year, 2025.
Double? From what base?
From $1.4 billion last year to potentially $2.9 billion this year.
Wow, that's significant growth. What's driving that success?
It's a combination of things. Improved ad formats, better programmatic partnerships, automated ad buying. And they're even integrating Gen AI for supposedly enhanced ad experiences, more personalization, basically.
And the number of subscribers on that tier?
Projected to hit nearly 60 million by the end of 2025. That really expands their market and adds high-margin revenue.
Okay, so strong financials, a plan for engagement, booming ad revenue, which brings us back to that neutral rating. Why maintain neutral if the underlying business seems to be performing so well? What's the hesitation from JPMorgan?
Yeah, it's a great question. What's really insightful here is how JPMorgan frames the risk versus reward. Despite all these positive fundamentals, the stock's valuation is, well, it's high. It's trading at a premium.
How high are we talking?
Around 34 times their projected 2027 GAAP EPS, the standard earnings metric, and 38 times their 2027 free cash flow.
34 times 2027 earnings. Okay, yeah, that's pretty rich.
Exactly. So those high multiples suggest the market has already baked in a lot of this future growth. JPMorgan sees strong performance, but maybe not enough upside from current price levels to warrant a more bullish rating. It's balanced.
Right. The price already reflects the good news. Okay, let's circle back to market share for a moment.
Yeah.
We talked about the big shows like Stranger Things and the new live sports. Are these enough to really regain share consistently against YouTube and others, or are they just temporary bumps?
Well, connecting it to the bigger picture, Netflix is betting heavily that they are enough. The strategy is the back half slate. This idea of eventizing big releases around holidays, adding live sports, it's all designed for sustained engagement, not just a quick spike.
So build habitual viewing around these anchor events.
Precisely, to regain and hold that market share over the longer term.
Makes sense. And one last thought on the advertising piece. Doubling revenue is huge, obviously. How does that fundamentally change their longer-term game plan beyond just adding profit? Does it impact content spending or global strategy?
It absolutely raises important questions about the long view. Doubling ad revenue really validates that ad-supported tier. It's not just a side project, it's now a core, high-margin growth engine.
Okay.
This allows them to reach more subscribers, especially in places where price is more sensitive. And crucially, it provides more fuel, more capital for content investment, which powers their ambition to become, as they put it, global TV.
Global TV, so a more diversified, larger scale platform.
That seems to be the direction.
So for the average viewer listening, what does this all mean? Sounds like more big shows, maybe some sports popping up on their Netflix feed.
Definitely. More choice, more event-driven content. From those blockbuster series we talked about to live sports. And that expansion of the ad-supported tiers, well, it means potentially more affordable ways to access all that content.
Right, impacting household budgets and how people watch.
Exactly. It reflects Netflix adapting to offer broader access while still finding new ways to grow.
So this JPMorgan report really paints a picture of Netflix navigating a complex streaming world with some clear strategic bets. It'll certainly be interesting to watch how these content and advertising plays unfold in the second half of the year. Lots to track for consumers and investors alike.